I have to tell you, when Vivek came to me and pitched his business plan, I was so impressed with him because he has so much passion. Even as a young entrepreneur, he's talking about taking on Bloomberg and doing these crazy things. So I invested in his company because I felt that incredible amount of passion, incredible amount of integrity. So Vivek, don't be nervous. It's always a pleasure to come and talk to you.
Yeah. So every time I meet him, he does the same thing. Every time. So anyway, sir, this time I've kept a format. Last time we interviewed the CEO of Britannia also, where we discussed a lot of marketing strategies and things which may be relevant for the entrepreneurs here. So I was talking to you about the quality of people out here. So we are largely owners of SME and MSMEs, extremely hungry to take our businesses to the next level. So apart from the investment process, which we'll definitely want to take us through, because there are a lot of people who are interested in creating wealth from 0 to 100 crores, as one of your YouTube videos has become quite viral these days. But at the same time, there are people who are owners of the business and they want their business to go to the next level. So maybe a few questions will be from their perspective and few questions will be.
Sure.
And I will keep the house open for all of you to participate in the queries, because I have some bit of queries which I will take for my own business. But at the same time, I'll be very glad if you guys have your questions, and sir would definitely participate in the answer. So sir, I want to start with plain simple entrepreneur and an investor. So you have worked in US for some time, and I believe you actually did coding also in US for some time. And when you came back, because your father had stockbroking business, so probably there was a compulsion for you to come back, if I can use that word. And you started looking at the market or the stocks, keeping into your existing background in mind, and I think you invested in Infosys because you understood the relevance of that coding and the technology piece and application of the same in the Indian market. So my question is that entrepreneur and an investor like you, what's the difference?
I think Warren Buffett said it best, but let me first explain to you, you as an entrepreneur, you feel, say you started a packaged food business, it didn't work out, then you tried something else. There's a very good interview with Steve Jobs. I don't know if you've seen that, where he did a commencement address at Stanford University. Has anyone seen that on YouTube? Yeah, I think 2-3 of you have seen that. He has a very powerful lesson in there, which when I heard it, I immediately connected back with my life. He said, called connecting the dots. And let me explain to you what he means out there. He said that when he was a student, he was also not very interested in studies. He wanted to take classes that interested him, not necessarily classes that were required to be taken. So when he was in college in California, he took classes in calligraphy, because he just enjoyed the process of calligraphy. And then he forgot about it, and then he moved on into technology in life. And 20 years later, when he was developing the Apple, this calligraphy courses came back to him because he knew he could use font to make the Apple output much more pretty. And because he did that, he had such beautiful font in Apple, and that's why the whole desktop publishing industry was born. The point he was making that really very little is wasted in your life. I mean, the lessons he learned in calligraphy class came back to him 20, 30 years later when he was designing the Apple system. So you need to connect the dots sometime in your life, which is a similar thing happened to me, as Vivek said. When I was in America, I was working in the technology sector. I was a coder. I used to actually write hard code out there. And then I came back to India, and if you remember in the 89-90 India, there was a big Harshad Mehta boom going on in the stock market. And the cement shares were doing the best. Every cement share was going up, and I used to feel so inadequate because here I was a freshman MBA from America, a guy who used to read a lot, and I couldn't name 2 cement companies in the world. I knew the Indian cement companies because I was here, but I couldn't name it. And then I thought, how am I so stupid? I mean, everyone, my jobbers in the market, knew the price of cement in Raipur, in Ranchi, to the last 50 paisa, and I didn't know the prices of these things. I said, how am I going to compete and make money out here? But then luckily for me, a couple of companies in the technology sector like Infosys went public. Now suddenly look at the advantage I had. No one in India understood technology. They were all looking at cement and steel and the old industries. I knew the new economy. I knew how these companies work. I knew that the fact they didn't have any assets was okay because they could own intellectual property at that time. So because of my background in technology in California, I was one of the first few investors who got into the technology shares. And those shares went up 100x, 200x, 500x over a period of time, which made us, people who invested in those shares, fairly well to do early on. But the broader point was that you feel sometimes you're wasting your time by being in this particular business or doing this particular thought process. But sometimes in life it comes back to help you tremendously, as my technology experience came back and helped me invest in technology stocks, because I understood the value arbitrage that India was operating. I understood the huge opportunity ahead. I knew these market caps that they were, I mean, does anyone remember what market cap Infosys came public at? It came public in 93. Does anyone remember what was the market cap it came public in? Take a guess. It was in 93. Huh? 10,000 crores? Okay.
50 crores.
Yeah, Vivek is close. 30 crores actually.
30 crores.
It's a 3 crore equity, 100 rupee price, about 30 crore equity it went public. Today it's maybe 3 lakh crore, 3.5 lakh crore market cap. Forget the amount of dividends it's paid back, the amount of buybacks it's done. It's been one of the great, really super stocks of the world, if you were there. So the point is that, Vivek, sometimes your life connects in very strange ways that you're not, fully aware of how some part or some help connects you there. So the first lesson actually in entrepreneurship is that there's very rarely any wastage in life. Sometimes remain curious, remain motivated, things tend to work out.
Right. Right. So again, an extension of that question is that being an entrepreneur, we always think of starting any product or any business with an intention of continuing it for eternity. So we literally get married to our product or our business. Whereas a value investor, I think the intent would is pretty much the same, but at some point value investors start looking at it from a overpriced or expensive valuation perspective and would think of exiting that company. Now, in today's generation of entrepreneurs, where especially the technology-led entrepreneurship, where the product or the business is developed with a clear intent of selling it off to someone else, because there is someone who is as big a fool as you are, who's ready to put money in your company at a higher valuation. So do you think the whole path of entrepreneurship, because you have seen the whole evolution of entrepreneurship in India, the whole path of entrepreneurship has evolved where people are no more building business for long-term sustainable?
I mean, there are two thoughts, Vivek, you mentioned out here. The first thing, if an entrepreneur is building something to sell it to somebody else, as you said, the greater fool theory, that's generally, in my view, a poor entrepreneur. A great entrepreneur wants to change the world. When you came to me, you didn't talk about, doing this and selling it to someone. You talked about changing how data and information is kept, and that's what attracted me to you. So it is very important that the entrepreneur have that kind of big vision, passion, and he wants to grow with that business. But let me take it from another perspective. I was speaking at an ANMI conference yesterday, and the talk there was on technological disruption that happens. And there are two kinds of businesses. Warren Buffett said he wants to invest in a business forever, that he will be able to hold forever. For example, he's held Coke in his portfolio for 40 years. He's held American Express for 50 years, Washington Post for 60 years. A lot of businesses lend themselves to forever investing. But given the cycle of technological disruption that we are seeing right now, the amount of disruption that we're seeing, sometimes you have to look at more what are called timely businesses. And let me just take you through both of them to see what the thought process in this is. Those who have seen the video would know this answer, but in the 90 years of the US stock markets, in 1920 to this thing, what has been the best performing stock in America? Does anyone who has not seen the video have a guess? What has been the best performing stock in America? Apple's been only listed for about 30, 40 years, so it's been a great stock, but it's certainly by no means the best stock. It's up maybe 300x since 1980. So, G, again, a good stock, but again, recently it's just collapsed completely. It's come back to the price it was in, I think, 2005 or 6, something in that neighborhood. Again, a good example. The examples are good, but it's not the best stock. The best stock may surprise you. Yes, of course, he knows because he talks to me all the time. So, yeah, the best stock is Philip Morris, which is a cigarette company, right? So here's it. Human habits don't change, okay? We're always going to smoke. We always want to drink. We always want to gamble. These habits don't change. So Philip Morris, from its price in 1920 to 2018, again, you don't answer this question, Yash. How many times has it been up? How many times has it multiplied your wealth? Go higher. Huh? Go higher. 2,000 times. Anyone out there? It's up 2 million times. Okay? So in 90 years, it's up 2 million times. But that's not the point. The point is in 90 years, if something goes up 2 million times, what is the compound annual rate of that growth? What is the what has been the rate of growth? The rate of growth is actually 16, 17%. Okay? That's what it's grown at. Nothing phenomenal. You say 16% with the bank interest will mil raha hai. But something growing at 16, 17% consistently, you know, over 90 years makes you extraordinarily rich. We'll talk about that later in the thing. So, and this is, just imagine this is an industry which has so much regulatory ban, so much social disfavor, so much price increase, so much taxes, but people want to smoke, and they keep paying higher prices for it. The company doesn't have to invest in advertising anymore, doesn't have to invest in technology. So they take the cash and give it back as dividends. So we include that. The stock has been one of the great performers in the business. So there are two components. A timely business also throws out a lot of cash. So it can generate it back to the shareholders. And people sometimes don't look at dividends, they look at growth. And that's a mistake to make because dividends are a very important component of your return. So make sure that the dividend is, you know, sacred to your investing process. You need to include your dividends back. The other thing about tobacco stocks that I must add, what has been the best performing stock in Japan? Japan Tobacco. What has been the best performing stock in India over the last 30 years? ITC. What has been the best performing stock in UK? Diageo, which makes liquor. Okay? So a lot of these sin stocks, okay, liquor, tobacco, have been some of the best performing businesses over long periods of time. And the very few businesses itself that will keep growing at 15, 16% over 30, 40, 70-year period. So it's very rare to find those businesses. On the other hand, you have a lot of businesses that are destructed. I just did a study yesterday that suppose you started a company in 1950 and you did well, it would spend probably 60 years in the S&P 500. 60 years it would spend in the S&P 500. Today, if you start the same company, it would spend about 18 years in the S&P 500. So there's a lot of destruction going on. Companies are shunted out, new companies are born. And yet, to get to $1 billion in valuation, used to take a company roughly 20 years to get to $1 billion in valuation. Now, there's a company in America called Scooter, which make electric scooters, right? It got there in 15 months. A couple of our own homegrown boys, the guy who's launched Oyo, for example, Baiju, the learning app, they've all gone to become unicorns, $1 billion valuation company, few years after they started. So there's a great tussle going on in the world between timeless businesses, which is the kind we like to invest in, buy and forget, hold on, generate it out there. But business itself is becoming destructive. There's a creative destruction that goes on in the business. There's a company in China called Ant Financial, for example. You'd be aware of that, Vivek, which has just killed the local banks, local serve, because it offers everything on a smartphone app. So in terms of destruction, what is the biggest destruction I see coming in the next 10, 20 years? Which, let me ask you this question. I don't know about Calcutta, but in Bombay, you're evaluated by three things. Which school do your kids go to? It's very hard to get admission in a school there. Which club you're a member of, you know, so if you're in a Tollygun's club, you're high up there. And where's your parking spot, okay? Parking is a huge problem in Bombay, right? So, in a good place, say in Park Street, what would a good parking spot cost out there? Does anyone have a guess? 20 lakhs, that's a spacey amount. In the society where I live in South Bombay, in Founder, it costs about 50 lakhs, you know, so it's sometimes more expensive than the car. The parking spot is more expensive than the car. But it costs about 50 lakhs. So the question I pose to an audience that in 25 years, what do you think will be the cost of that parking spot? What will be the cost of the parking spot? Yeah, you've also seen my video, I'm sure, right? Good, but that's good, right? But why did I say zero? Maybe you can help us answer the question. Why do you think it will become zero? He's very good. He's absolutely right. He got the gist of what I was saying absolutely accurately. What will happen is that we'll go to what is called first an electric vehicle car and then an autonomous vehicle car. What is an autonomous vehicle car? It will be driven without the help of a driver. It will be driven by software completely. Once that happens, suppose I finish this meeting out here, I just take out my phone, click an app button, say take me to Alipur where I'm staying. It will take me and then drop me and then go to pick up somebody else. So just like, for example, in 1900, horses were very common, right? But can you ride a horse today? No. You want to go to maybe Baliganj Club and ride a horse out there. Otherwise, you can't ride on the street. Same way, you like to drive a car today, right? You like to go on the street, get the feel of a drive. Won't be able to do it anymore. You'll have to go to a racetrack and do it. All the cars will be autonomous. If everyone is autonomous and it's a fleet, you don't need to own a car. Think about it. How much time do we drive a car? Actually, it's 5% time, 10% of the time. Most of the time it's parked under an office or under a house or in a club, right? So we'll all own these autonomous cars, be fairly cheap, fairly easy to get to out there. If you don't own a car, why do you want to own a parking spot, right? So my big contention is that these parking spots will go down to zero in value, as he correctly pointed out. I tell that to my wife and she throws me out of the house. So she doesn't let me sell my parking spot. But the fact of the matter is that it's, just because we think a parking spot is always valuable and we should always hoard it and do ho gaya, teen rakh lete hain. But the technology does not allow this. It keeps, us thinking about things. I'll give you another example from my own financial career. When I started my career in the stock exchange, 1989, I got in luckily through a quota. The BSE was selling 50 cards and they wanted to encourage professionals to come in there. So I applied and I managed to get one. I paid a princely sum of 6 lakh rupees in 1989 for the card. At that time in the free market it was maybe 10, 12 lakh. So it wasn't that much of a bargain, but I got it for 6 lakh. Within 3 years, the value of the card had gone to 4 crore rupees, right? At that time, being a broker at the BSE was like being a train conductor on a busy train route, okay? Everyone begged you for a seat, everyone paid you any amount of money to just do their business. And yet, BSE had 90% market share. 30 years later, in 2018, BSE has 10% market share, NSE has 90% market share. What happened? Technological disruption, right? The BSE was complacent, it had an outcry system, it had jobber-based system, it had, antiquated Bombay Club. NSE came, opened the membership, anyone could become a member, pay 25, 50 lakh deposit, you can become a member. Electronic system, so people from Raipur could trade, people from Calcutta could trade, could trade from Bombay. Better price discovery, the jobbers used to take a lot of goal in between, as they say, but here it was transparent to the screen, so you could tell the client I bought it for you at 2010 and instantly confirm it to him. The balance of gravity shifted towards the NSE. So BSE went from 90% market share to 10%, NSE went from 10% to 90%. BSE also digitized, it was too late. The market had already shifted to NSE, right? So these kind of technological disruptions will happen to your businesses tomorrow, is happened to my business, which is the broking business. So the trend is you need to move to a higher value addition business. For example, textile business becomes commodity. So how do you survive in the textile business? By going into fashion, by keeping on moving up the value scale. Your broking business became obsolete. How did we survive in this? By moving into wealth advisory, asset management, giving clients better service than just simple transactional broking. So while we always look for a business that can sustain for 10, 20, 30, 50 years, increasingly we'll have to grapple with a lot of technological change going on in the market. And the way you survive in the technology business is to keep moving up the value chain, all right? Don't think of yourself as a limiting person. I'll give you another example before I finish up this. It was again my presentation, so those of you who've seen the presentation will be repetitive for you. But the two biggest companies in the photography market in the 1980s when I was growing up were, of course you're all younger than me, huh? Kodak is one and Polaroid was the other one, right? The fact is we've now as per capita do so many more photographs, right? The amount of selfies we click is, almost astronomical, right? And yet the two companies most entrenched in photography are bankrupt, okay? Kodak is bankrupt, Polaroid is bankrupt. Why is that? The photography market has exploded, right? But why are the two dominant companies in the photography business bankrupt? Okay? The answer is that Kodak and Polaroid thought they were in the limited, printing or photograph business. They were run by people with chemistry backgrounds. So they were always interested in how you print a photograph out, how you display it on an amble. They could not understand that people will exchange it through electronic means by clicking selfies, posting it to each other, and being able to snap. They always believed photograph had to be printed. So the guys who made the money understood the electronics part of the business, not the chemistry part of the business. And that was the fatal flaw that they have. So any business, if you think yourself too narrowly focused, you don't think, if you think you're in the taxi business or you think you are in the, moving about business, but not in the transportation business, you won't see Uber coming. You say, "Main to taxi chalata hu, I'm thinking of myself in the taxi business." But think bigger. You need to be in the transportation business. You need to keep reinventing yourself. Okay? That is the lesson that 30 years of the stock market have taught me, that there are some timeless businesses, and if you get them, you back up the truck and buy as much as you can, or you stay in that business. But very, very few businesses meet that test of being a timeless business. The rest of the business, you will destruct yourself, reinvent yourself, destruct yourself, reinvent yourself. And unless you're educated on top of this thing, I don't think you'll be very successful entrepreneur without reinventing yourself every few years.
Right, sir. Sir, the members of this chapter, I've been interacting with them for almost a year now, and I see the propensity to invest in direct equity is pretty low with the members here who are still coming from that strata of society which has some bit of financial savings to park it into direct equity investment. Well, when I interact with them, and all of them are stockage users, so when I interact with them,
they're all smart people, Madhav.
They're smart
That
people.
one's guaranteed. Right?
Yeah.
If they use stockage, they're smart. I'm an investor, so I have a personal interest in it.
Thank you, sir. So when I ask them that why aren't you putting your money in direct equity, so the inevitable answer which I get from them is that we are too busy in our existing business. And I believe I'll rather put my money in my existing business where I have more control than giving it to the other entrepreneur who is running his company. Whereas we have a segment of society like you who believes in empowering the entrepreneurs either by investing in listed or in the unlisted space. But at some point of time, these people, they would miss an opportunity to invest in good stock which can probably generate more return on capital for them than their own business. So do you think, can you suggest any cheat sheet or anything which they can do, or would you recommend them to actually invest in equity and focus more on their existing business and not look out for other equity investments in the listed space?
Vivek, it's an involved question. The first advice I'll give you is that if you're running a business, you should keep running that, okay? I truly believe that you are your own best capital allocator. So if you are a lawyer or you are a hairdresser or you are, a building contractor and you generate a sustainable return on investment in your business and your business requires capital, the first thing you should always do is invest in yourself. Just like I would not recommend investing in stocks. You invest in your business. Your Apple, who knows, can become Bloomberg tomorrow, right? So I want you to encourage you to invest in your own business because you don't know where your business can take you, right? So I would encourage all of you to do that. A lot of businesses can't take more capital, okay? If Vivek starts generating 100 crores a year in cash flow, his business won't require that much capital. Then you go into investment. That is a fair point. But the first principle of this, Vivek, is that you invest in yourself, okay? And your strength, your area of competence. You do that. That's what my suggestion to you is. Beyond that, if your business can't take more capital or the return on capital is not great or it's stuck in accounts receivable, stuck in inventory, then I understand. Then you start moving to investment. So make a two-stage process. But always benchmark yourself, what is your return on investment capital, okay? It can't be that you're using your services at zero, using your father's factory warehouse, which costs you zero, and then making a capital. You should do an honest evaluation. Is your business earning a return on capital? If the GSEC bond is at 8%, you should be generating 10% return on capital with true cost accounting done in there. If you do that, keep investing in yourself. That is the best investment you'll ever do. But if your business cannot generate the kind of return or it can't use that much more capital, then the public markets are a good place to go in and look.
All right, sir. So there are a couple of attendees here who are investors also in market, full-time at the early age. Now, they had a question which they posted to me right now that investing is an extremely boring activity and it involves a full dedication in reading and just trying to figure out things which are out of the box. They wanted to know at your early stage of when you decided to invest in the market, how did you deal with that boredom of involved in the investing process?
My wife used to say that, reading, no acting. And that's what she used to criticize me about. Because it's a business that, it's like watching grass grow. It can get pretty boring, right? So I used to have these fantastic theories. I used to tell in the 80s when I was just starting my business that I think India will become a $2 trillion economy, and that the per capita consumption of, at that time it used to be Xerox copies, could be Gillette, whatever. We have 1 per 100 people using a shaving machine today. This will go to 5 per 100, and you know what that'll happen to my stock once that happens. So all these fantastic theories, I used to keep talking to her about that. Because I used to read about them, right? So my best example stock that I became well known. How many of you have seen the film Diwar? This Amitabh Bachchan sir. Everyone's seen the film. So good, you'll relate to the anecdote I'm about to tell you. There's a scene in Diwar which you'll all remember. Amitabh Bachchan, Parveen Babi, they're sitting in a bar at the Oberoi, right? Amitabh Bachchan was a bit of a crook at that time in that movie, and Parveen Babi is a lady of easy virtue out there. But they've become friends, which is great. So they're sitting in a bar, and this Parveen Babi is in a nice, provocative dress, and she swivels towards the camera and says, ये शराब भी बड़ी अजीब चीज़ है. अमिताभ पूछे क्यों? बोले इसे देखो, ये पी रहा है क्योंकि खुश है, ये पी रहा है क्योंकि आज गम में है, ये पी रहा है आज दोस्तों के साथ है, ये पी रहा है आज अकेले है. Remember, this is a timeless business. Alcohol is a timeless. People will always want, alcohol or drink with buddies or, do something, social, if you will. So when I came to the stock market and I started looking, maybe in 2001-2, you could buy the entire alcohol industry in India, okay, the liquor industry in India, which includes beer, spirits, wine, all of that, for maybe $150 million US. The United Spirits and Breweries own 50% of the market. Together worth about $150 million, 500-600 crore rupiya the us time. So the entire industry was worth about $200 million, let's say, okay? Because they own 50% of the market share. Now, think about the way I was saying about India at that time. We had 1 billion people. We had GDP growing at 8% at that time. We had every year, I forget the exact number, a huge percent of people become 21 years of age, which to me meant they could start drinking, right? And we were still a non-Islamic country, so there's no social prohibition against drinking. And we realized how young people throughout the world behave. They want to go to a happy hour, they want to have a good time, whatever. And yet these companies were available so cheap to us that time. And the way I used to explain it to some of my friends who are back there in the audience, I would tell them that, so say McDowell was worth 200 crores at that time. The value of McDowell's was 200 crores. So I would tell them that, okay, you can buy 10% of McDowell's for 20 crore rupees, correct? Because 200 crores, 10% to 20 crore rupees. And what does that mean? That means every 10 bottles of beer sold, one is yours. That's the way I used to think. Ownership of a business. Every 10 bottles people drink beer, one I have sold. That's the way I used to think out there. Or I said, you can take the 20 crores and buy a flat in NCPA, which is in one of the prestigious buildings in Bombay. 20 crore mein shayad milta, shayad 25 crore lag jata, I don't know, but it was that expensive. Now think about what I'm saying, the value proposition available to you, that you could buy a flat in NCPA and probably live comfortably, but nothing beyond. Or you could buy 10% of India's alcohol business. Think about what I'm saying. Look at the value proposition sometimes that these opportunities offer us in the stock market. So if you do that kind of math, it makes a lot of sense to look at the stock market.
Right. So I've interacted with you quite a lot, and I see that your approach is extremely top-down approach. You actually try to figure out the size of the market opportunity and then pick the best candidate in that opportunity. Is that true, sir? Is this, can I conclude that statement?
Vivek, I do both, to be honest with you. I will do top-down. For example, I saw after the tech boom in India with the computer software boom, like I told you about, the Infosys, Wipros, TCS doing well, I realized that telecommunication become cheap in India. Finally, it had become, regular telecommunication costs. So there's a big boom in BPO businesses in India. So it's a top-down approach. You look at BPO and buy there. But occasionally I look at companies also from a bottom-up approach. They're just too cheap. For example, the public sector stocks which I bought in my career, I bought a company called Bharat Electronics at about 40 rupees, which implied a market cap of 300 crore rupees. They were a dominant supplier of defense equipment to the government of India. 40 rupees, $2 dividend, that is a 5% yield, these stocks were available for. So I did the bottom-up analysis. I realized as soon as the turnover went over 1,800 crores, it would start hitting the bottom line, and which is exactly what happened. The stock, luckily for me, went up from the price at 40 to almost 200x over a period of the next 15, 16 years. Company didn't do anything great. It grew at 12, 15%, but the sheer amount of profitability that came because of the leverage they had made that a great stock to buy. So to be honest, I've done both. If you ask me, I tend to do more bottom-up than top-up, but I enjoy top-up also because it gives me the intellectual satisfaction of figuring out a trend.
Right, right, sir. Sir, before I keep the question answer open for the floor members, the last question is, because quite a lot of us are entrepreneurs here, if you can give a pictorial view or maybe a 10,000 feet view of the fundraising plan which an entrepreneur should do. When an entrepreneur should say that, yes, I'm ready now to go to the market to raise fund. Because you have seen all scale of entrepreneurs raising from the market.
Yeah, I'll answer this two parts. First part is, what do outsiders look for in an entrepreneurship? I think when someone on the outside looks at an entrepreneur, they want intelligence, they want passion, and they want integrity, okay? And if you have intelligence and passion but don't have integrity, you lose it all, right? So people won't invest in you or that, The really good investors tend to look for the matrix of these three. All these three things must be in, close collaboration with each other. The integrity part, the intelligence part, and the, promise, the opportunity, the passion part of you. But integrity is very, very important. Your alignment of interest between the person who's putting the money and you should be there. And you must treat that capital as sacred as yours. It's not that because you got cheap capital or access to capital, that can be blown away in a fancy car or a holiday or, a great office structure. So it's very important to kind of do that. When is the right time to raise money? I don't really know, to be honest with you, about that. But typically, if you're a good entrepreneur today in India and you have like 3-4 years results, people will come to you. There's so much private equity fund going on, so many VC funds deals running, that if you're a guy who's shown a scalable opportunity and has produced a good set of numbers, I think people will come to your door. You don't have to go to them.
Right. So, maybe I can just rephrase this question, that is it a good time for an entrepreneur of, say, old school businesses, turnover of 50 crores to 400 crores, is it the right time for them to look at equity market fundraising for coming 5 years perspective?
I think so because, again, one of the wisest persons I know in the stock market, who's seen 50-year career in the stock market, has seen all the booms, busts, whatever. And I think someone asked him a very poignant question. He said, okay, you were lucky. You were at the right place at the right time. The index was 800 when you started. Today it's 36,000. But what about us? 36,000 ho gaya, sab ho gaya, So what do you think, they asked him actually, is the best time in your career to have invested? Was it in the 80s? Was it in the tech boom? Was it in the India liberalization boom? Which was the best era to invest in India in the last 40 years? And without missing a beat, he said, the best era to invest in India is the next 20 years, right? Because the opportunities in the next 20 years will be far superior than they were in the last 30 years, as good as they were in the last 30 years. Like I told you myself, the index went from 636,000, 60x move in the index itself. But the wisest man I know feels the best opportunities will be in the next 20, 30 years. Why is that? Because we are a nation of 1.2 billion people, so a natural market that is so huge. How many countries have a kind of market? China has this market, we have this market, okay? We dwarf every other market. There's rising aspirations for the entire class in terms of consumption. So the India that grew at 3%, so-called Hindu growth rate is now over. We'll grow at least at 6%. Bad governments will make us grow at 6%, 7%. Good government will do at 10%. I don't think we're going to get a good government in India, so don't hold your breath. I won't hold my breath. I think we'll grow at 6-7%, but that's good enough for us. And as India's economy is about 1.2 trillion, 1.3 trillion, it get to $2 trillion, it get to $4 trillion, you know. Maybe it gets there in 8 years, maybe it gets there in 10 years, you know, I don't know that. But look at the tremendous opportunities that will be unleashed once, you know, we get to $12 trillion. See, what happens is that if you grow economy at 7-8% a year, your economy doubles every 10 to 12 years, right? So in a generation, the economy goes up, I think it goes from 1 to 2, 2 to 4. 4x move in the index in one generation out there. If you can go at 12 or 13%, you basically do 16x move, okay? So it's very important, morally very important, because there's such unemployment, such poor backward standards of living, that our government try and grow this at 10, 12%. But I'm saying if it doesn't happen, we'll still do a 4x economy in the next 10, 20 years, right? Which is great for improving living standards or whatever of people.